You read the headlines about trade wars, tariffs, and manufacturing jobs disappearing from American towns. But what if the real battle isn't fought with tariffs or angry tweets? What if the deadliest weapon in the global economic arsenal isn't a missile, but a simple, invisible number? The exchange rate? I'm talking about the currency war. A hidden, perpetual conflict where central banks, not armies, decide who wins and who loses. And in 2015, China fired a devastating shot, a currency devaluation so precise, so calculated, that it sent shockwaves across Wall Street and guaranteed thousands of lost jobs in America. What if this move wasn't just a reaction to the market? What if it was a secretly executed strategy to keep the American consumer addicted to cheap Chinese goods while systematically dismantling U.S. manufacturing? This is the story of how China weaponized the yuan. And the single terrifying lesson is this. In the 21st century, currency devaluation is the ultimate form of economic warfare. The costs were immense. The consequences are still being paid today in every struggling industrial city. Before we unseal the documents and analyze the true cost of this financial attack, tell me, where are you watching this unfiltered truth from? Drop your city in the comments and hit subscribe now. Because understanding this strategy is the only way to protect your job and your future. To understand the currency war, you must first understand the fundamental lie of global trade. The price is right. Imagine you manufacture toys in a factory in Ohio. Your costs, labor, steel, taxes, are all paid in US dollars. Your competitor manufactures the exact same toy in China. Their costs, labor, steel, taxes, are paid in Chinese yuan, CNY. The exchange rate is the bridge between these two worlds. For decades, the Chinese government, not the free market, artificially kept the yuan weak against the US dollar. Let's say the official, fair exchange rate should be $1 barn 5 yuan. But China artificially sets it at $1 barn 7 yuan. Here is the simple, brutal consequence. When an American company wants to buy the Chinese toy, they suddenly get 7 yuan worth of production for their $1. The Chinese toy instantly becomes 40% cheaper than your American-made toy. This isn't fair competition, it's financial engineering. This systematic, decades-long manipulation allowed China to flood the global market, especially America, with cheap exports, turning them into the world's factory. Sound familiar? This artificial price gap led to the transfer of millions of manufacturing jobs out of the US and created the massive structural US trade deficit that persists today. By 2015, the Chinese economy was facing internal slowdowns. Their stock market was crashing, and capital was fleeing the country. The government was desperate to protect its massive manufacturing sector. The problem, the yuan had actually appreciated slightly, making Chinese goods slightly less competitive. The solution was not to reform. The solution was an ambush. On August 11, 2015, without warning, the People's Bank of China, PBOC, announced a sudden devaluation of the yuan by almost 2%. This doesn't sound like much, but in the slow-moving world of central banking, this was a nuclear bomb. The global market went into shock. The S&P 500 plunged. Currencies across Asia and Latin America went into freefall. The fear was simple. If the world's second-largest economy was resorting to competitive devaluation, a full-blown global currency war had begun. This move was short, sharp, and absolutely calculated. It was entitled, Reforming the Yuan's Exchange Rate Mechanism. The lie they sold was that this move was a step towards a market-oriented exchange rate. The truth was, it was a powerful targeted strike to boost Chinese exports, immediately making goods like electronics, steel, and textiles cheaper for American buyers. The catch. The American consumer benefited from slightly cheaper imports, but the price was paid by the American worker. The economic receipt for this ultimate financial transaction, the cost of China's move, should be studied in every economic class. It is the playbook for turning trade into a weapon. But you won't believe the name of the former U.S. Treasury Secretary who quietly allowed this to happen, and how much wilder the ripple effect is than you think. Let us delve into the most dangerous financial mechanism, competitive devaluation. This is the core reason China's economy gained an insurmountable advantage. At its simplest, competitive devaluation is the act of deliberately weakening your national currency to gain a trade advantage. It is a beggar-thy-neighbor policy. You try to solve your economic problems by making your neighbor's problems worse. Think of it like running a marathon. When the yuan is weak, China is running downhill, and everyone else is running uphill. The economic consequences are profound. The theft of manufacturing, the American loss. When the yuan devalues, imports become cheaper for the US, putting massive, unsustainable pressure on domestic manufacturers. They cannot compete with the artificially low price. Factories close and jobs are lost. This systematically hollows out the industrial base of nations like America. Shocking statistic. Barry 1, 5.8 million jobs. That is the estimated number of U.S. manufacturing jobs lost between 2000 and 2017, a period of aggressive yuan manipulation leading directly to the crisis felt in the Rust Belt today. The dollar's trap, the global instability. China's devaluation created the dollar's trap. To keep the yuan weak, China had to take the billions of U.S. dollars they earned from exports and buy U.S. Treasury bonds. This meant China became one of America's largest creditors. Shocking statistic number 2. At its peak, China held over $1.3 trillion in U.S. government debt. This created a profound, dangerous interdependence. China's economic model depended on selling cheap goods, and America's fiscal model depended on China buying its debt. This is the ultimate moral hazard. America got cheap goods and cheap credit, while China got market dominance and leverage over the U.S. debt market. The shadow cost. Inflation and wealth transfer. The Chinese devaluation was a shadow tax on the American consumer. First, cheap imports kept prices low, giving the Federal Reserve the illusion that inflation was under control, leading them to keep interest rates artificially low for too long. This fueled the asset bubbles in housing and stocks that inevitably led to the 2008 crash. Second, by buying so many U.S. treasuries, China kept U.S. interest rates low, allowing the U.S. government to accumulate more and more debt, the $35 trillion figure we often discuss. Shocking statistic number 3. Economic studies indicate that the yuan's artificial undervaluation acted as a subsidy of nearly $275 billion per year for the Chinese export machine, paid for indirectly by American workers and taxpayers. The consequence is a system of parasitic finance where one nation profits massively by systematically depressing the wages and industrial capacity of its trade partners. Shocking statistic number 4. The U.S. trade deficit with China alone has soared to over $300 billion annually, cementing the structural imbalance caused by these currency tactics. The history of the 2015 devaluation destroys the illusion of free markets. The Chinese devaluation was the proof of concept that in the 21st century, economic power is shifted not through open war, but through complex financial policy. The two eternal lessons are clear. 1. The exchange rate is a weapon. 2. The cost of cheap goods is paid in domestic jobs. Today, the system operates faster. China, Russia, and other nations are actively moving away from the dollar-centric trade system, de-dollarization, preparing to fire the next currency shot. The U.S. response, sanctions and trade restrictions, only escalates the war. We are no longer talking about a 2% devaluation. We are discussing the potential for a complete global breakdown of the dollar's dominance, the petrodollar's final hour. Shocking statistic. 5. Since the 2015 devaluation, the yuan's share of global trade settlements, while still small, has grown by over 300% in specific markets, proving China's long-term strategy of shifting global reliance away from the dollar. Our modern world demands our denial. We are required to deny that the clothes on our back and the electronics we use are cheap because they cost American jobs and national security. We are required to deny that the fundamental rules of trade have been broken by central banks. Ponder this. Are we wiser now or walking the same path in better suits? If you believe that this hidden currency war must be understood by everyone, share this video widely. Expose this hidden truth to your network. And subscribe immediately so we can continue to unpack the hidden mechanisms that control your life and your wallet.